In today's video, I'm going to show you exactly what we are doing to prepare for higher interest rates. Everything from how we've changed our budget to how we're managing our mortgage and our payments to the exact type of mortgage that we're taking out to protect ourselves in order to make sure that we can withstand any sort of future rate increases. And you'll want to stick around till the end to see exactly what we're doing with our money and also exactly that mortgage that we're using to make sure we're protected from higher rates. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, so welcome back. Today we're discussing the 5 things that we're doing to prepare ourselves for higher interest rates, just in case the worst happens and interest rates continue to go up and up and up. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where we're gonna give away $5,000 to one lucky subscriber. We're just 500 subscribers away. So go ahead, click that subscribe button and pay attention to the next few videos, because we're gonna tell you exactly what you need to do to be entered into that draw in order to win that money. All right, so let's get into it. Let's discuss the 5 things that we are doing. This is my wife and I personally to prepare for higher interest rates, because we know that they're coming, and the difference between the people who absolutely suffer a ton as a result of higher interest rates and those who don't is basically what you do right now to prepare. And there's several things that we're going to talk about today. I want you to stay till the very end though, because there's 2 specific things that we're doing to make sure that we're prepared, as well as a specific mortgage that we carry on all of our properties personally that is set up in such a way that it'll protect us from higher interest rates should we need it. So stay until the very end to make sure you see those 2 things. And let's start first and foremost with the number 1 thing that we are doing to make sure we are prepared for higher interest rates, and that is we're not panicking. That's right, we're not panicking. I know that higher interest rates seem like it's a lot. I know it seems like it could be painful financially in the near future, but there's a lot of things that are still on our side when it comes to interest rates. Obviously, when we look back at Tiff Macklem 18 months ago, telling pretty much Canadians that you can borrow whatever you need to because interest rates are going to remain very low for a very long time. And at the same time, they released a monetary policy report that suggested that interest rates would remain very low into 2023. This happened in Canada. It also happened in the US. Obviously, a lot of us are surprised by the higher interest rates right now. Now, of course, you're going to find a few people in the comments who say, oh, you should have seen this coming. Money was being printed, so on and so forth. But the things that are actually causing the inflation, the supply chain issues, the war in Ukraine, those are things that nobody expected to happen, and to happen to the extent that they did. We didn't think that prices were going to go up substantially because goods would be hard to get. And let's call a spade here. The reality is that most of the issues we're having right now have more to do with supply than they do with demand, although the heating up in the economy is leading to significantly more demand now. And the question is, what does the next 3, 6, 12 months look like? It looks as though interest rate increases are having an effect on borrowing habits. We're already seeing real estate markets start to slow down. We're already seeing people start to change their buying habits as a result of just 3/4 of a point in interest rate hikes. So hopefully further interest rate increases are going to have a significant impact, and we're going to see rates start to slow down. The other thing to keep in mind, and why we continue to tell people not to panic, is because you have to keep in mind that most people have been qualifying for mortgages at a rate of around 5 to 5.25% for the last several years. And therefore, with that stress test combined with the pre-existing stress test, which was debt servicing ratio, so the percentage of your income that can actually go to your debts and your mortgage and everything else, most people have had to qualify for significantly less of a mortgage than what they would have been able to, say, 10 or 15 years ago. And that has built in basically 20 to 25% in extra room for people should interest rates go up or should payments go up. So again, the big thing here is just not panicking. By the way, if you're panicked, if you're living paycheck to paycheck, if you feel like a couple points in interest rate increases are going to have a significant impact on you, and that you are going to not be able to make your mortgage payments, it is a good time to get ahead of that rather than behind it. And you should perhaps be thinking about downsizing, getting into a smaller house, a smaller mortgage, and getting yourself set up so that if interest rates do go up, you're not in a position where you have worse things happen, like losing your house. The second thing that we're doing is we are finding as much savings as we possibly can right now. So we're doing things like cancel subscriptions that we don't need. Yes, we're one of those people that canceled Netflix, like many, many other people recently. We are canceling things that are just too expensive And we are just doing everything we can to purchase goods in advance of them going up in price. Things like staples in the house that we know we are going to need 3, 6, 12 months down the road, we're buying in advance before the prices go up. And when we have the opportunity to save money on things that we know we are going to be buying anyways, we buy them in advance so that we not only get the savings, but we also avoid the future increases in prices that could potentially come down the road. So if you absolutely know that you're going to need that new car, probably a good time to buy it sooner rather than later, although probably not a good idea to get a big loan on it, but probably a good idea to buy things that you think or suspect are going to go up in price sooner rather than later, especially if you can get a deal on them. The third thing that we're doing is we are reorganizing our finances. We're looking for other ways that we can save money. For example, we just got rid of a vehicle that takes premium fuel, traded it in for a vehicle that takes regular fuel. That's a 15 to a 20% savings on gas right out of the top. And on top of that, we're looking at riding our bike more places. When we want to go pick up that bottle of wine on a Friday night, we're riding the bike down there or we're going for a walk. Yesterday, my wife and my kid decided to walk to the grocery store rather than taking the car. And that's a double win because they got the exercise and they saved that little bit of fuel that will ultimately end up saving a little bit of money over time. Now, if you want to get really deep into this, go ahead, create a whole new budget and start slashing things out that you don't need or that you can be saving money on, but get really, really good at making sure that you're saving every penny you can. And by the way, one of the best ways to do this is by going ahead and getting rid of as much debt as possible. And by the way, if you've got consumer debt and you've got equity in your home, now is a good time to do a refinance to get rid of that consumer debt and lower your payment obligations across the board. The number one thing you can do right now, if you have equity and you have the ability to refinance and pay out debt and consolidate debt, is to do that, because getting rid of those big credit card payments and car loans are one of the biggest things you can do in order to save money over time. This is where it gets interesting, because this is where we're going to talk about what to do with your mortgage in order to make sure you're set up for higher interest rates. And by the way, don't think that this is just for variable rate mortgage holders. If you are in a 5-year fixed mortgage, you are not safe from rising interest rates. You are just going to have a delay of the inevitable, while at the same time probably paying a little bit more for that 5-year fixed security, only to have it renew in 5 years and end up having what we call payment shock, which is where your payment goes up significantly overnight on renewal when the mortgage resets to a different rate and potentially a higher rate. So pay attention to this regardless of if you are a variable rate holder or a adjustable rate holder or a fixed rate holder. Obviously, you guys know my opinion. Adjustable rate holders will obviously have some savings over the next little while, but they will also be in a situation where their payments are gradually adjusting and where they are getting used to higher payments over time, and therefore aren't going to find themselves in a position where they have payment shock, much like variable and fixed rate mortgage holders may. So here's what we're doing and what we're recommending to our clients. Obviously, pretty much anybody who has gotten qualified for a mortgage in the last several years has qualified at what's called the stress test rate. That's around 5 to 5.25%. So what we are suggesting to people is that they calculate what their payments would have been at 5.25%, and they start putting away the difference between that amount and their current payment. And this is really easy to do. You can go to the link in the description below. It has access to our mortgage toolbox calculator. And all you do is you calculate out your original mortgage payment. This is our original mortgage payment, $480,000 mortgage, 2% variable rate with a 25-year amortization schedule. Yes, I'm paying slightly higher of an interest rate. The reason why is because we have a special mortgage that's going to help us out should interest rates start to rise. I'll tell you about that in a minute, but as a mortgage broker, we practice what we preach. We don't always go for the lowest interest rate. We go for the product that makes the most sense for us. And for us right now, especially with higher interest rates on the horizon, the mortgage that had the most flexibility made the most sense. And we're willing to pay more for that. And that is coming from people that could get any mortgage that we want at pretty much any rate that we want. We had all the choices and we chose to pay a higher rate, just so that we could be safe in the long run. And I'm going to show you how we do that in a sec. But first, I want to show you how you calculate that difference in payments. So you go into the simple mortgage calculator, which is that one right there, plug in all of your numbers. And for us, we pay accelerated weekly because it breaks up those payments into smaller increments, which makes them easier to pay for us, which is what most of our clients do nowadays. By the way, accelerated weekly payments and accelerated biweekly payments are almost the identical thing. We just like to chop them up into smaller increments. And basically all you do is you go in here, once you've got the numbers in, you put in the higher interest rate, and it'll pump out what your payment would be if you were to be paying that stress test rate of 5.25%. And then once we've punched in that 5.25% interest rate, what we see is that the difference in payments is about $210 per week. So that for us is about $840 difference between the stress test rate and the rate that we were actually paying at the beginning. And what you can see is that stress test rate has built in a pretty significant increase in payments for us. That is the payment that we've been qualified on, so we should be able to pay it in the future. And then from there, it's as simple as we start taking that $840 a month, and on the same days that our payments come out for our mortgage, we have it auto transferred into a TFSA. We use Questrade. I'll put the link in the description below for that as well. And the money just goes in there, gets invested into a S&P 500 index fund, and it starts to grow as time goes on. And if it gets to the point where the payments start to feel a little bit stressful, what we'll do is we'll go in and we'll start subsidizing our payments from the fund that we've created by taking the difference between that stress test rate and our actual rate and putting that aside into an investment. Now, the bonus here is, let's say that we find ourselves in a situation where we've never had to use it. Well, guess what? We've now got about $10,000 per year that we're going to be putting aside, and we can use that down the road if interest rates don't go up for other things like maybe retirement or a vacation fund, or maybe the down payment on another rental property. But at the end of the day, everybody should be able to take money and put it aside regardless of how they feel about their finances, because you've qualified at that 5.25 rate before, and you've got a pretty significant amount of bandwidth that you should be able to afford. Now, I mentioned the special mortgage that we have. It is one of the best mortgages in the country. It's what's called a Scotia Step Mortgage. So there's a couple of things that we really love about this mortgage. First and foremost, it is an adjustable rate mortgage, not a variable rate mortgage. So what that means is that our payments change when the interest rates change. Therefore, as interest rates go up, we start to feel the payment increases gradually, and our mortgage continues to pay itself down at the same rate that we had set it for previously. The other big thing that it has is what's called a readvanceable line of credit. Now, we don't use the readvanceable line of credit, but what happens is as we pay down principal on our mortgage, the line of credit becomes available to us. And as a result, if for whatever reason interest rates went up and we didn't have enough in our TFSA fund that we've been putting money away for to subsidize our payments, then what we could do is we go back and reaccess all the principal that we've paid down over the last 5 to 10 years. So that mortgage alone is why we're willing to pay a slightly higher interest rate than most people would, because we know that we've got a mortgage that's set up so that in the worst case scenario, we can continue to subsidize our payments from a line of credit that's been made available just by having the right mortgage and the right setup. Now, in order to get that Scotia Step Mortgage, there's a couple of things you need to know. I'm going to link to a video up here as well. But first and foremost, you need to have at least 20% equity in your property. If you do, it makes a ton of sense to go ahead and refinance into one of those mortgages. By the way, I recommend that you have it set up through a broker to make sure that it's set up properly. And you get this set up in such a way that you know that you can access your equity at any time and the principal that you paid down. And that alone, should the worst happen with interest rates, which I don't think they will. I mean, remember, we said we aren't panicking. Well, I don't think we're going to find ourselves in a situation where we absolutely have to panic, but it is better to be prepared and not have to use the things that you used in preparation than to not be prepared at all. And again, it comes down to what people do right now, today, in order to make sure that they're prepared for rising interest rates. Those that take action now are going to be okay. Those that don't, who wait until what happens, could find themselves in a world of trouble. But at the end of the day, this all comes down to good mortgage strategy, having good mortgage advice, and knowing, especially if you're in a 5-year fixed mortgage, that yes, interest rates increases are inevitable. At some point, you are going to feel the pain of them if they happen. The question is, are you going to be prepared for it? And what are you going to do to make sure that you're prepared so that you don't find yourself in a really crappy situation? By the way, if you are in the market for a mortgage and you want to know how to get the lowest interest rate, of course, you can apply for a mortgage through Mortgage 360. Or if you have a family member that's a broker or works for a bank, or you're already working with somebody, we have a course called Secrets Getting the Lowest Interest Rates. It is available at ratesecrets.ca, and it is designed to be able to prepare you to negotiate with your bank, with your broker, know all the landmines and surprises that could come up with discount mortgages and big bank mortgages, and make sure that you're in a situation where you're prepared to make sure that you not just get the best rate, but the best mortgage for yourself. It's priced super low right now. You can go in there. I can pretty much guarantee anybody who takes that that course gets 10 to 100 times their money back. In fact, we've put a special offer in there to make sure that if you do end up using Mortgage 360, you'll get at least 10 to 15 times your money back just for signing up for the course. So go ahead. Again, that's ratesecrets.ca. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers, and we'll see you on the very next one. Cheers.